afternoon, everybody. Welcome to TraderMerlin show for your Tuesday edition. A special one because I just apparently don't have my camera on, but we'll turn that camera on to get this show going here in just a second. Our guest today is no stranger to the program. I try to bring him on once a month, but things happen. I can't get him on all the time, but it brings so much information to the table on a broad spectrum of asset classes, and he's got a popular thing he loves to do with his students, and I've been trying to get him to do a monthly newsletter on this one, but maybe that's something that'll happen down the road. It's called the B.E.C.C Report, which is bonds, equities, currencies, and commodities. I'm joined by none other than Mr. Scott McCormick, CMT, joining us from Texas today. Scott, how you doing, my friend?
Doing well. How are you?
Good. Glad to have you back on the program. I think it's been maybe
a while.
2 or 3 months. I feel bad because I hate asking people to come on the program because there is no real monetary reward. It's just talking about markets, but I'll try to get you on more frequently.
Well, it just so happens I like talking about markets, so don't be shy.
You and I are both addicted to it. I've been doing this. I think this year we've done 177 shows, and I do probably about 200 and something every year, and all for free, all for fun. What's new in your world? What you been up to, my friend?
I was going to say 5'11", 270.
Wow.
Yeah, it's the COVID-20, my friend.
What happened to the insanity courses?
Oh, I know. I don't know. I guess it was just too insane, especially as I have aged. No, but I'm back in the gym, weight training, doing what I actually really enjoy doing. So
great.
Yeah, some of that's muscle, but emphasis on the word some.
Good. No, it's good. I tell you what, one of the things that I've done in the past, I've done this a few times on the program, and Tom encouraged me to get it going again, is I do a challenge for a month where you just pick something that you want to do, and some people are like, I'm going to read a book every day. So here is the November challenge, and if you guys want to participate, just type it in the chat. I will add you to the list. It won't happen immediately because I'm obviously in the middle of an interview, but I'm going to be doing, for the month of November, 100 push-ups a day, plus Larry Jacobson, who hasn't seen his abdominal muscles in probably 35 years, is doing an ab challenge, and I'm going to do that ab challenge with Larry. Tom sent me a thing saying I'm going to do 300 body weight reps, and the other side of this is no violation of his trading plan, meaning he could take losses, but they've got to be within the parameters of his trading plan, small losses, and whatever wins come his way. So that is the two that I have up there. If anybody else would like to join our November challenge, I will revisit this on a regular basis to help motivate and push you. Gary says, drink scotch every day. Well, we all have our idea of what a challenge is. That's not challenging. That's actually just called fun, doing that one.
For me, that would be a challenge because I'm just not a big whiskey or bourbon guy.
Really? What's your beverage of choice?
Hard alcohol, probably tequila.
Oof, okay.
I mean, a good tequila, though. It's like it's got to be solid, but
so it gives you some nice the run-of-the-mill Jose Cuervo charcoal filtered stuff. That's it.
Yeah, no. And I've tried the Mezcal wrap, but going that route, but it just that doesn't really do anything for me. So I've got I usually like the añejos and the reposados, and so give me a good one of those, and I'm pretty chill.
Done. We just figured it out. There we go. Right. All right. Let's go into the B.E.C.C report, which obviously, as we saw, is bonds. Did I finally get it right? Because I think I always screw up. It's bonds, equities, currencies, commodities. Correct?
Commodities and currencies.
See, I get it. So I don't know why it's always backwards. I'm going to fix my graphic because I actually recycle this graphic. I just changed the background picture, which is nice fall, autumn leaves right now as we go into November. But let's start off with the bond market. It has been a crazy ride. At the beginning of this year, the 10-year bond started. It was at 1.52%. We recently, just a couple of weeks ago, hit 4.335, which is a 100% gain in the yield of the 10-year. And who knows what on earth is going on with it and where it's headed, but maybe you can shed some insight and some perspective on what's going on with our bond markets.
Yeah, I think our colleague Bill Addis would probably have a little bit more insight as to the actual details behind what's driving the move. My perspective is always technical in nature. For those that are not familiar with me, you mentioned CMT and Texas in the same sentence earlier, and I'm like, yep, not country music television, but chartered market technician. And so, for those that are kind of new to the program or new to me, my specialty is technical analysis. And, the whole idea behind the B.E.C.C report is to look at each of these asset classes, bonds, equities, commodities, and currencies, because there's a rotation between those from a larger macroeconomic perspective in how they perform throughout an economic cycle. And, I spend time once a month going through looking at the monthly chart because, of course, that's when the monthly candle closes and certain things take place. And so, I'm looking at a chart going back to 1973 of the 10-year yield. And one of the really kind of important things, I think, for your listeners to really kind of notice, that there was a major trend line break from 1987 going through to 2022 that was broken in May. And
I'm
so,
drawing it as you speak, so
yeah, so it's going from the high closing candle there in September of 87. I'm very specific.
Do you do the wick or the body on that one?
So my rule when drawing trend lines is that if I'm drawing a downtrend line, I draw from the high of the highest closing candle to the high of the highest closing candle. So it's a little bit more specific as opposed to just going to the absolute high in that area. Because if you were to look at, for instance, like October of 87, there's a shadow that's a little bit higher, and it can affect the slope, obviously, of the trend line.
So you're doing okay. So you're basically, I got it. So basically, the September candle there in 87 and the October, the October one opened at the same price that the September one closed. So you're using those two prices.
Yeah, so kind of starting there, and then you kind of run into the closing from March of 89, and then you come into the high of 1990, and then you get into the high of 94, and then finally you've got like a test of the high there in 2018. And finally, back in April, May, we closed above that. And so the reason why that's going to be important is because you've now broken a multi-decade downtrend in interest rates. And, one of the things that, we kind of note quite often in doing our supply and demand analysis is that a lot of the times the market will actually revert back to where that transition between supply and demand actually take place. And so, just doing some quick analysis here, I wouldn't be shocked to see interest rates actually get up to about 7%. And so we would be revisiting some of the levels that we saw back in 1996 and possibly even, back in January of 2000 and around like the 6.8%. So, let's kind of give it a range there, 6.5 to say 7% in terms of interest rates, which, that's another 50, 75% higher from where we are right now. I think the bigger implication here is, of course, how this is going to affect the consumer. A lot of people immediately, they're going to think about not just interest rates, but of course, mortgage rates. How's this actually going to have an impact on the housing market? How much, one, is it going to slow down on new construction, which could actually have a negative impact on employment, being that that's actually one of the bigger employers, here in the United States. And then in addition to that, once you start to get into those higher interest rates, obviously home prices are probably going to have to become much more competitive as borrowing rates are going up. And, nobody wants to pay a $2,000 mortgage for the same house as they could, let's say 3 years ago at $1,000, or instead of paying $2,000, they now have like a $4,000 mortgage or whatever. But in addition to that, potentially having an impact on, those that tend to carry credit card balances, because as we have a very leveraged consumer, probably not as much as what we had, let's say, back in 2008. I haven't looked at those figures lately, but these higher interest rates can obviously bleed over into the credit card side of things, where a lot of people actually, spend their money. So that can have a slowdown on the overall economy as well. So it's going to be very important for us to kind of keep a close eye on those things. Now, of course, everything can kind of revert back to where it was before. If we were to kind of take a look here and actually, if you don't mind, I'll just go ahead and share my screen here.
Sure. Before we move on, just real quickly, when we look at this chart, and I have the yield of the 10-year up right now.
Yep.
one thing that I find not necessarily alarming, that might be a little bit too intense of a word, but concerning is the speed and trajectory of that move. And the ascent that we've seen from on this monthly has obviously been pretty aggressive since 2020, but really the last year or so has been extremely sharp, and you can see it pulling away. I have a red trend line drawn amongst the lows that started in 2020. It's kind of that elasticity of price where when it moves up so quickly, quite often you get a real quick snap back down towards its average. And the only time I've seen moves of this slope was really that sell-off that was back in the late 80s as it was coming down. I don't really see too much of it to the upside here. Does that play into your analysis with regards to the strength of the yield or maybe just the money pouring into it? I mean, how does that factor in?
So rate of change is going to be important. And I think the other thing too is this, here's the flip side of the coin, right? You now have interest rates for investment vehicles that haven't been at levels that we've seen in almost a decade. Right. Meaning that a bond investor, they haven't been able to get 4% or 6% yields on the 30-year or the 10-year.
Right.
They just can't do it. Right. So now these yields might actually be attractive enough to actually kind of slow down the rate that these bonds have actually been falling. Now, of course, as new bonds are issued, we'll have to see what those interest rates come out as at the auctions, but and actually see where like the real demand is, and that really kind of gets into a different type of analysis here. But as we take a look, going out and again looking at monthly charts and looking at where we are coming back to some areas of demand from back in 2010 that can at least potentially slow this decline down. Might see interest rates kind of pop back up to, or I'm sorry, not pop up. I was looking at the bond price here a moment ago, but maybe come back down to like 3.2, possibly even 2.5%.
That's what I've got drawn too. Yep, 3.25.
And depending upon what the Fed actually starts doing, which we're going to have their announcement tomorrow afternoon, what's that going to actually do here to these interest rates? Because they've just been jacking up the rates, but the economy really hasn't slowed down that much.
Yeah, it's interesting how that you're right. There was the expectation they were going to have a 75 basis point increase tomorrow, and then in the December meeting, another 75 basis point increase in the Fed funds. Now it's still the expectation we're going to get 75 tomorrow. That's pretty much, it's an 88% chance that that's going to happen. So we'll call that a foregone conclusion. It's really what is going to be said about December going forward. Now I'm hearing and seeing by the futures market, which I will share for everybody here. Here is the Fed funds futures pricing in for tomorrow. You can see 88.8% chance we'll see 75 basis point increase. But when I shift out to December, this is where it's changed quite a bit. It's definitely been getting lower and lower on that front. We're seeing less of a chance of there being a 75 basis point increase and more of a chance of just 50 basis point increase. So that might be somewhat encouraging, and maybe part of the reason why we're starting to see these markets heat up a little bit is, okay, maybe the Fed's backing off. Maybe they see something that we don't. Personally, I still think we're going to see more aggressive hikes and keep putting the pedal or hitting the brakes until we see inflation crack.
Yeah, and it's always kind of funny because like for me personally, my experience with the Federal Reserve began with my career. I started at Schwab back in May of 2000, and anybody that's been around that long, they're familiar with what was happening in the markets. And one of the things that I always heard from colleagues is, well, if the Fed cuts, that's good. If the Fed hikes, that's bad. It's like, okay. But when you start to look at the actual effect on the markets and why they're cutting or why they're raising, it's kind of actually inverse to that, because anytime they're cutting the interest rates, they're cutting the interest rates because they need some sort of stimulus to kind of help support the economy and kind of keep the wheels turning and or kind of turning faster,
Right.
And the opposite tends to be true as well. As they're raising rates, yes, that can have an impact on borrowing costs, et cetera. But the reason why they're doing so is because things have been good from a demand side.
Yep.
We've seen a strong economy.
You got to put the brakes on. You got to put the brakes on at some point.
They're trying to slow that down.
Right. Yeah. Totally.
So, and these are things that, they don't happen overnight. The Fed isn't looking from one quarter to the next necessarily. They're looking out a number of years. And so, it's possible here that, if you start to kind of go down that route of like looking at the Federal Reserve and what they're actually doing, looking at the rate of change in their Fed funds rate and how quickly they're hiking, the size of the hikes, is going to be pretty important, because there was a while, going back almost a decade now, where they kind of just were moving interest rates, but then all of a sudden it stayed kind of unchanged for a number of years.
A long time. 2009 to 2015, we didn't do anything.
Yeah. So it's I hate to say it's just one of those things, but it is. And at the end of the day, and I was saying this to students yesterday in our XLT, that regardless of what our beliefs are about the market, who's going to do what, how it's going to impact the market, at the end of the day, you're either going with the price or you're going against it. And if you're going with the price, you're going to make money. And if you're not, you're just going to lose money. And so, I try to keep it that simple, which is part of the reason why I like to analyze price charts the way that I do, because, especially going out to the timeframes that I look at and in the durations, I get a better idea as to what direction the tide is actually going.
Right.
So it's like I can be wrong in the short term, but if I hold that long enough, I'm probably going to be right. And of course, all of that is relative.
Sure.
But anyway,
in our current climate, we've seen the Fed funds rate go pretty quickly from 0 up to 3.25, where it's at right now. From your perspective, as we move through your BEC, let's bring us to the equity side of things. And obviously, a rate increases of that magnitude, and it's a collective increase of 3.25%, is going to start to impact the economy. And certainly, it's borrowing costs, it's the cost of capital for businesses. And things are great when you can borrow money at near zero. But as it gets to 3, 4, 5, 6%, it becomes an impact on your business directly. And we've seen these equity markets roll over a bit here. I'll bring up some of the markets so our viewers don't have to stare at my ugly mug. Seen a pretty sharp decline there in the past few months, really going back into January. What do you see the impact of these bond yields increasing and the Fed funds on our equity markets, and what are your thoughts on the equity markets going forward?
So, I actually, may I share the screen?
Yeah, go for it.
Okay, so it's disabled though.
Oh, there's always that. I always have this problem. Right. Let's see. I'll get there eventually. Damn, nabbit, how do you do this? There it is. I'll be there in a sec. I just got to find out the dang button. Share screen. There you go. Now you can share it. Sorry about that.
Awesome. All right. Let's. So what I have here is a chart of the Fed funds rate and the S&P 500, right? Because ultimately the question is, well, what kind of impact do you think this might have on the market? And this kind of goes back to what we were talking about just a moment ago. We had this period back in the early 2000s here when the Fed was actually raising rates, but the market was actually moving higher. And then, of course, they started to go into that easier monetary policy, and we saw that the markets went down. But as we're looking at this right now, we're kind of seeing the inverse of things, right? So as we look at where that rate really started to kind of move higher, we've seen kind of that acceleration to the downside here on the S&P 500. Although this is, let's see here, this is a little old because October does not look like that. This is September, actually. I'm not sure why I'm not getting an October candle here, but we've obviously turned higher. So, if this relationship continues, then, I would expect to see, of course, further equity prices to the downside. But I think this earnings season and the next are going to be a pretty important read in terms of how these higher interest rates are affecting not only the earnings for the companies, but also investments going forward. Because to your point, we had a period in time here when interest rates were incredibly low, borrowing rates were low. So when you start to get into how this is going to impact various companies, I think one of the things that you're going to have to start to really kind of get into is how much cash do they have on the balance sheet? Right. How are those assets invested? How much debt are these companies actually carrying? So really kind of doing a lot of that type of analysis from a fundamental standpoint to really kind of get an idea as to how this is going to be impacted. From the equity side of things here, this is a monthly chart of the S&P 500, and I apologize, it's very marked up, almost to the point where you almost can't read this. It's for my eyes only, until I just shared this, right? But when I look at the S&P 500 here, what really kind of goes through my head is, and I think I just hit the wrong combination of keys here. I just tried to make this an algorithmic chart, and it's not cooperating with me, and it's frozen. Are you there?
I'm here. Yeah.
Okay. I'm not sure what I did there to my, all right. So here we go. I'm just going to go back to this. So as I'm looking at, something is going on here. Yeah, sorry, it's frozen. I'm going to turn my screen back over to you.
No worries. I'll take it back.
So ultimately, as I'm going through and looking at this, let's see here. The longer term trend, the point that I was trying to make here is that the longer term trend in the S&P 500 has been in a major uptrend for a long time. And I actually just have this fixed, so I'm going to take this back over if you don't mind.
Sure.
So again, I'm going back and I'm looking at this for as far back as I can possibly go, right? And so this chart, which you should be able to see here, is a chart of the S&P 500 cash index. Okay, I don't plot out the futures from a long-term standpoint. The SPY, it only goes back, I think, to like 1993, but this is going back to 1960s. And when we take a look at this, you can see obviously the overall bias of the market is to the upside, and we can get into all of the reasons why that is with the replacement of stocks, et cetera, et cetera. But this is a very important thing that happened here between 1974 going into the highs in 2000, and then from 2000 going into 2013. This period in time here was considered a secular bull market. Okay, so these are bull markets that typically last more than 18 years. We actually ran into a secular bear market. And the reason why these things are going to be very important is because when the market does go down, it goes down in a very different fashion than what it would, let's say, during a secular bull market. The secular bear markets tend to be longer declines, deeper declines, whereas the secular bull market, they tend to be shorter and shallower. And when you take a look at where we are right now, we are back into that secular bull market phase. Now, the reason why this is important is because even as the Fed actually enters into this higher interest rate environment, we are in kind of a stock market environment, if you will, that might be more supportive of those changes and higher rates than what they would have, say, 20 years ago. And so as we take a look at, actually, I think it's the screen sharing that's doing this to me. It's locking up. But as I take a look at this, what has happened is that, we've obviously gone through a retracement here from the highs there in June going down to the lows here just this past month or in late September. And what has basically happened here is that we've come back to an area of demand, another spot where we've also kind of broken out from those February 2020 highs. So we can actually find a little bit of support here inside of the market. And one of the other things that's also very interesting to me is that we have gone down as far from the high to the lows. So the highs back in January to the lows there in September, as we did from the highs in February of 2020 to the lows in March of 2020. And for me, from a charting perspective, and I'm going to stop my shares here, see if that helps out the computer. But for me, the reason why that becomes important is because if you look at the market from a cycle perspective, meaning that the market is always trending, there's always a cycle where we see kind of that dip and then expansion. We've obviously gone through a dip, and so to me, the question, of course, would be where is going to be the next expansion? When is that going to start? And so I've been not adamant, but I've basically in the mornings when we do our guided pathway session, I do broad market analysis every day, and we've been talking about this and how I'm basically looking for reversals here of the downtrend that we've seen since January. Now, that doesn't necessarily mean that that's going to happen. We could very well trade deeper and go back down towards the lows from March of 2020, which would put the S&P down around 2,500. But if we do manage to see this market turn from these areas and move higher, I think it's going to catch a lot of people off guard. And when that happens, you've got a lot of money that has to rotate, right? And so you start thinking about where that money would actually come from, how that would transpire. And so, here, bonds have gotten beaten up. So I doubt that there's a lot of longs that would actually exit those positions, but there might actually be a lot of shorts that would exit those positions. And so if you've got shorts that have been inside of the bond market, that's money that they have to buy, which could actually slow down the decline of, again, the bond market. It doesn't necessarily mean that you're going to get a huge bounce because you need new buyers coming in. But if that money actually rotates back over into the equity side of things, that could actually push the S&P 500 back up to about 4,800. I'm looking at targets a little bit higher than that, though.
Wow.
Yeah. So we because that was about let's see here, 2,200 to 4,700, 4,800, let's call it 2,600 points. So that would actually put the S&P over 6,100.
Wow.
Yeah. But again, that would be something that I would think would kind of transpire over the course of the next 5 to 10 years.
Oh, okay. So yeah, okay. Yeah, and I think
that's not something that's going to happen here in the next year.
That's what I was going to get into. It's like if I look at this, yeah, certainly there's always the least expected move, right? A lot of people look at the markets and will say, whichever way most people expect it to go, it'll go the opposite. Right now you're seeing overt bearishness. Hell, even the Fed and central bankers are saying markets are going to be going down, expect pain, yada, yada, yada. So you look at all the different catalysts or factors that are pushing this market down, and I don't see too many things that are going to cause this market to pop to go up. You mentioned a rotation of capital, but at this point, it seems to me like so much of the profit, so much of the money that's been made is ghost profits. It's paper profits that has not been locked in any way, shape, or form. So waiting to see how that all gets filtered out here. I do think we're going down. As the viewers know, I've got a 3250 target on this market going down, which is those lows from, not lows, but the later part of 2020. And we'll just have to wait and see how it plans out. I think the best part is, Scott, and you would agree, that whether you're bullish or bearish doesn't particularly matter as long as you have a plan in place to take advantage of it.
Yep, that's exactly right. You should always have a plan for what to do if the market is going up, down, or sideways. Is it going in your favor? Is it going against you? Is it doing nothing? Always have that in place.
All right. Let's go bonds, equities, currencies, and commodities. I always get that one wrong, and I will try to fix that. I don't know how it is that I've had you on the show a dozen times talking about it, and I still get that one wrong. Let's talk about the commodity side of things. I've been making the argument that, if we keep seeing commodities sell off at the rate that they are, at some point that's going to seriously impact the bottom line of inflation, because that's the cost of goods, etc. Give me your take on what you see as being hot, exciting, and in the commodity space.
So what's very interesting, and again, I think it's kind of caught a lot of people off guard, is that, with all of the talk in inflation, gold has actually come down in price. Yeah. It's not been the inflation hedge that a lot of people have looked to in the past. And a lot of the reason for that is because of the strength in the dollar. When we consider what the dollar did, let's say back in oh goodness, I don't know what's happening to my hotkeys here.
Trying to be too fancy over there with that TradingView, huh?
It's unfortunately here. What's happening is that I may have closed out some important charts on my windows that I didn't mean to.
That will happen. No worries.
I've got to close that desktop and not save any of the changes. So let me actually just bring it up here on TradingView here really quick, and I'll just kind of do this on the fly.
Sure.
So wow, nothing is responding. What is going on here?
Oh, well, you could, worst case, you can just tell me and I will draw it out here. I'm kind of following along with you. So I
was going to bring up a monthly chart of gold and plot with it a chart of the dollar index, DXY, coming from.
No, I can't do that. I can't do multiple charts. I don't pay for TradingView.
I don't either.
Really? I think you go up here, and if whenever I try to do like a side by side like you just had, it says I have to have a 30-day free trial. Other than that, I can't have multiple charts. I try.
Yeah.
I'm just too petty to pay the money. I'm waiting for it to be in CliK, and then I don't have to worry about paying for it.
There you go.
Yeah.
All right. So here, I think I may have resolved my issue here. Let me.
Real quick, while you try to figure that out, Chris asked me, Merlin, are you expecting 3,200 in this year or next year? Next year. I think it's going to be a slow drift down. If you look at the chart that I have on the S&P futures, and again, I could use the SPX, I'm really looking at this blue downtrending line right here. So we had a little pop up. I kind of expected that to stall out. It looks better to me on the daily, since that's what my main time frame is. And then I think you'll see this thing just drift down. I don't think it's going to be an abrupt, catastrophic thing, but I think you'll just see it slowly drift down towards those 3,200 level. It's still quite a ways away, especially with the pop that we've had. If you look at from current price where we're at now, getting down to 3,200 would be a drop of 17% from current levels, and that certainly is a sharp stick in the eye for a lot of people. But if you're short, it's good.
Yeah.
Almost 5,000, Big Eb. I know, I'm so close. I'm just teetering on it. It would be funny if they gave me a little alert that showed me who actually was the 5,000 subscriber. But yeah, it's kind of cool. We're getting there. We'll get there.
Very cool.
All right, you got your stuff fixed over there?
Yeah, I've got it fixed.
Excellent, Smithers.
That was really good, man. So you guys should be seeing a chart of the dollar index on the top here, and the gold contracts here at the bottom. So a big difference here in what happened, let's say back in the early to mid 2000s, there was that as gold was going up, right, the dollar was actually going down. I mean, going into the 2008 lows there, that was a low going back to at least 1986. Here, what we've had is the opposite situation. All right. So the dollar actually kind of got its second bottom here back in May of last year and has continued to trade higher. And as that has happened, it's kind of put pressure on the ability of gold to actually move higher. So even though we've been talking about all of this inflation inside of the market, one of the things that's actually been, I think, helping out the consumer has been the fact that our dollar is as strong as it is. And nobody seems to really be talking about that, because if we had the inflation the way that we had, or that that we've been posting, but we've also seen the dollar, trading the way that it was back in 2008, things would be a heck of a lot worse than where they are right now.
Yep.
That said, when I take a look at this, a lot of what's happening right now in commodities, I think, is really going to be predicated upon what happens here with the dollar index. And again, I realize this is difficult to read. There's a lot of 4-hour chart analysis that is in here that I share with our students, our mastermind students every morning. But those that are in the know that I've been watching this area right here on the dollar index, which is in and around that 117 to 120 area. For the dollar. And I have a couple of measured moves here, measuring prior advances and projecting them from these lows back in March. And because we did have kind of the sideways range, kind of projecting that height as well. And they both actually end up and around that 119 area. So if we continue to see the dollar advance the way that it has been over the past year and a half now, I would continue to look for at least the metals to go down. So obviously gold, copper, silver. The other part, though, that I think is really kind of important here is that when you start to compare, various commodities, and I don't spend a great deal of time analyzing these, but gosh, I don't even know what the electronic symbol is for soybeans. I still use the old symbol on the other platforms. So
soybeans futures? It's ZS1 exclamation point.
Yes. All right. Thank you.
Yep.
All right, here we go. So on this, you'll notice that, soybeans have continued to trade higher here. And actually, let me just kind of clear out these drawings. But on this, just kind of going through some old school technical analysis, there was obviously some resistance that was in and around this area, which we approached back in June of this year. The big question, of course, is do we get a second test of that move, or do we actually take out this low here from back in October of last year? That's really going to be the big thing. And the reason why I'm kind of focusing on The food side of things, as opposed to the the physical metals here, is because soybeans, for one, that's in a lot of the products that we use, but it's a food item, right? And this is part of the area where we see a lot of people kind of getting hit the most is their food costs. So on here, again, this is really going to kind of be a big tell here. If we do manage to get down below that 1177 area on a monthly close, then it probably wouldn't be a big surprise to get back to that 2020 area of about 887. Let's call it 954, somewhere right in there. But as you can see, we've just basically been in this massive range here, right? So I wouldn't be surprised to just kind of be stuck inside of that. And this is going back to 2008. So it's not the first time we've seen soybean prices up and around this area. If we were to do the same thing here for corn, okay. You can see it's very similar in appearance, and again, I apologize. So these are really old lines. I don't use TradingView for my longer term stuff, but as we go through and we take a look at this, you can see again we got it towards the upper end of the range. There was certainly some supply back here that kind of acted as a headwind going back in April. So the big thing here in the short term, and I say the short term, that's versus the last 10 years here. But if we manage to take out those lows from last September in corn, I'm looking for prices to kind of get back down towards the lower end of the range. And wheat, I think, is going to be an interesting one here, because obviously you've got a geopolitical issue going on with the war in Ukraine and everything that is happening with the wheat exports and the agreements and the lack thereof. But again, massive range here between 1354 and 385. But all of these items here, they've managed to kind of back off over the past few months, much like what we've seen in some of the physical metals. So again, if the dollar continues to trade higher, it should continue to put pressure on some of these commodities. So they might remain elevated, but they might not go up as fast as what they were previously, and that's going to be.
And given what the Fed's saying about selling bonds and returning all that cash that they create out of thin air, I mean, it would seem logical that dollar is going to keep on rallying up. To that extent, you actually, let me just go back here and show everybody, because I think that this is, I showed this one yesterday because I got to give you props on this bad boy, which was the US dollar Japanese yen. And of course, nobody knows for sure where anything's going to go, but it's always nice to have a plan in place. And as you guys can see up at the top here, January 5th, I do this occasionally when Scott mentions things like Scott M 1522. So on January 5th of this year, he said, I see the yen going to 150. And at the time, I think a lot of people were like, yeah, right, 150, it's so far away. If you look back at January of this year, here's January, we were trading at 114, run 15, somewhere in that. So, to have a move up of 35 points in the USD JPY is incredible by itself, especially in such a short period of time. And I can't remember all the logic as to why you thought it was going to be going to 150. I guess that's all moot point at this point. What are your thoughts on it going forward now that we've hit this milestone of 150?
Yeah. So again, it's important for your listeners and viewers to know that, there was no macroeconomic thesis that went behind that target, that call on the dollar yen. All it was just based on long-term price analysis. All right. And I hate to make it sound so simple. And I managed to kind of take care of my issue here, but this is the chart that we were referencing back in January. And again, just to kind of give a little bit of context here, January was right here. And there was a bit of supply that was trading here in this area, going back into this, because you can again see that the Japanese yen was in this kind of massive consolidation. But when you zoom out here and you focus on what was happening in the long term, we had this low that was created back in 2011, and we advanced back up to this long-term downtrend line here in 2015, and so you would expect that if the long-term trend was going to continue, not only should the Japanese yen have declined, but it should have kept going, right? I mean, it should have gotten down to like 94, possibly even 80. And that's the dollar yen, not the actual Japanese yen. But it clearly didn't, right? It created this range, and we finally kind of broke out of that range. Well, this kind of goes to an earlier comment that I made, in that, if you view the market as a cycle, our cycles don't necessarily oscillate like you would see on some sort of electronic equipment. Our cycles, they trend, right? So you have that expansionary phase and the contractionary phase: expansion, contraction, expansion, contraction, etc. So one of the things that I do is I will measure the expansions and the contractions to try and get an idea as to how far that market might go again. And basically this target that you see here, which is at that 149 area, was just simply a measure of that expansion going from the lows to the highs, and then projecting that distance from the lows here back in 2016, where that market just really kind of entered into a range. And so, as I look at this, right, the big question now is, of course, what is going to happen? And as you can see, we're pretty much right back up towards a very major area of supply here on the Japanese yen. But also keep in mind that we've managed to break this longer term downtrend. So if I had to really guess, because at the end of the day, that's all this stuff really is. It's just an
educated
guess. Yeah. I would be looking back at around this area where the market actually broke down from. And so on that, if I were to go through and just kind of use the idea of old support becoming new resistance in the marketplace, and I'm looking over here to the right to where my areas of confluence might be, right? So I still have this major expansion here that I've projected, and just because it hit 100% doesn't mean that it's going to stop there. It just means that this is a target, and so I need to pay very close attention to the price action going forward. But as I look at where these old areas of support are relative to the Fibonacci extension here, you'll notice where some of these actually kind of line up. And so I'm just pointing out these three here because it's an area of confluence. And so we have a 161.8 extension, we have a 200%, we also have a 223.6%. So that could put the yen upwards of 180 to 200 to 11 on the dollar versus the yen. So as I look at something like this, it's important for your viewers to note that I pay attention to the daily trend as we get up into those areas, because if I do see, for instance, that the Japanese yen gets a weekly to a monthly close down below this swing low here that was formed on the daily chart, which is the last swing low relative to where this hit, then that tells me that impulsive move is over, and that we're more likely to move back into a correction, right? And so my analysis would basically revert back to the last correction that we had, which was here. And so assuming for a moment that we do top out here and we don't continue to advance, but basically kind of going back to what I was saying a moment ago, it's a series of if-then statements for me. If I see a weekly close below 140, I know that we're in a correction, in which case I could probably look for the dollar yen to come down to about $1.25, which just so happens to also be the place where it broke out from, right? Not to mention the fact that we also have an area of demand that is sitting right there as well. So again, you've got all of these different areas of confluence that kind of line up. But at the end of the day, I always back this up with price analysis, right? So if I know that these are my long-term targets, I do drop down to those daily charts and 240-minute charts and start paying attention to, okay, well, I'm expecting some sort of an event to take place here. And so if I'm looking for a reversal, let me plan that out, because as Dow theory says, trends continue until they reverse. So if I see that there's an uptrend, I'm just going to look for that to continue until it doesn't.
Yeah, and I'm a huge fan of that concept, but the trend is there's a normal sustainable trend, and then there's the parabolic not going to last forever kind of trend. And I think that in the USD JPY, to me, it seems like we're in that not sustainable for much longer trend, at least without a significant pullback here. I mean, that thing's been just about parabolic. It looks like the chart of Bitcoin. I mean, it's just bam. Yeah.
Anytime you exceed like a 45-degree angle on a chart in one direction or the other, that's pretty steep, right? I mean, this is not quite 90 degrees, but damn close.
Well, if you zoom out and stretch it out, it'll make it 45 degrees, right?
Right. I mean, if I compress my chart enough, it's almost 90. But even here,
Yeah.
you know, it's that is a steep move. And when you look back, you know, the last time that we got close to a move like that was back here in 97, right?
Yep,
That was probably the Asian financial crisis, if I'm not mistaken.
Even that's not as steep, you know, and that was just that was a
Right.
huge crisis over there, and it's still not as significant as what we're seeing right now.
Yep. Yep. And there's a possibility too, by the way, that, you know, we see this carry trade happening because our interest rates are so much higher versus some of the other foreign currencies, and they just continue to get whacked. And you know, you can also see it in the bond market. So you know, until there's another opportunity for these funds to kind of go play with, that might just continue.
Anything else on the forex front? I mean, I know we had parity on the euro, which were still sub parity. You had the British pound was screaming towards parity, which was an absolute shocker. That was incredible. You know, every central bank around the world except Japan is raising their rates. Anything else that's noteworthy on the currency front?
So what was really kind of interesting here, I was going through and again, kind of just, you know, combing through some of the charts, you know, for our show today, and you know, and taking a look at the euro. The euro, I've got targets on this thing still down around, you know, 88 on the euro. You know, on the British pound here, see if the projection is still on here. This isn't going to make our friends across the pond very happy, but you know, I'm looking at 95 on the British pound. Yeah. And it's, you know, and of course I have to take into consideration that, you know, the central bank had stepped in and they started buying bonds. So it's going to help support that currency. And you know, in Japan, again, they're kind of known for doing that, and they'll do it out of nowhere. So you've got to be pretty careful when you see really kind of steep moves like this, because when that central bank intervenes, you know, it could be a very interesting battle.
Yeah, I think that they're going to do whatever they can to stop it from getting below parity. I mean, I'm sure in history maybe it has, but on all the charts I've looked at that go back into the 80s, nowhere close. 105 was the lowest, so pretty crazy.
Yep.
Scott, you mentioned GPS, Guided Pathway sessions. You've got sessions in the mastermind community as well. What's your schedule look like? I know we've got a lot of people who are Online Trading Academy graduates. And I know that the sad part is a lot of people will take courses or sign up for things and just not utilize their resources. So I would encourage everybody, get back in there. If you've paid for classes, retake your classes and learn as much as you can from these guys like Scott McCormick and others. What's your schedule like, and where can my viewers find you?
So, you know, I start my day pretty early. So at about 7:50 a.m. Eastern, I get on the mic and I go through various markets. There's typically 11 markets that I cover every day. They include equity markets, currency markets, basically, you know, kind of a highlight of what we did here today. I don't call it the Beck report, but they're kind of getting an abridged version of that. By looking at bonds, equities, commodities, and currencies. And I do that every day, Monday through Friday. It's mastermind students Monday through Friday. On Fridays, our XLT students have access to that as well. So you'll see the head count kind of go up those days, which is nice. And then on Mondays and every other Wednesday, I host a kind of a longer term stock portfolio XLT. So our stock XLT students can go in there and we go through and we look for various opportunities that are a little bit longer term. And obviously we tend to focus on the long side of things. So we've had fewer opportunities obviously in this past year, but there's still some, right? And so it's always kind of fun finding those stocks that are, you know, going against what the general market is doing, like McKesson or Toro or something of that nature, you know,
right.
UNM. So, but yeah, so those are pretty much my contributions to Online Trading Academy, and spend the rest of the time just staring at my charts, placing trades.
I love it. Stare at those charts, place some trades. Well, I appreciate you coming on and giving some insights into it. I know we've got some people here who are not part of the OTA family, so hopefully I introduced Scott McCormick to the world out there. If you guys would like to know more information, contact Online Trading Academy. Scott's mentioned he's got sessions for the Mastermind community Monday through Friday at an ungodly hour of the morning, 7:50 Eastern Standard Time. Also does a stock portfolio on Mondays and every other Wednesday. You can find him in there. So Scott, thank you so much. Hope you have a fantastic remainder of your day. Now that Halloween's over, you can get all your Christmas decorations up, and hopefully I'll see you next month.
All right, sounds good.
All right, take care. Bye. All right, everybody, that was Scott McCormick giving us the Beck report. I could realistically sit and talk with that guy for 5-6 hours at a time. It's just engaging, and I see all kinds of little things that I find informative to myself, and maybe I can implement into my plan. Especially as talk track about finding these markets at a level much higher in 5 to 10 years. When he was saying those numbers early on, I was like, whoa, you really think the S&P is going to get up to those levels? But yeah, sure, 6,000. No problem thinking in 10 years we'll be at 6,000. That's the nature of the beast. But where are we going to be in a year from now? And I think this is really a difference of trading and investment strategies, right? If someone's going to hold for 5 years, then it doesn't matter if the market drops 20 or 30%. If your target is 6,100 on the S&P that's currently at 38, well, I would argue that why ride it down and take a loss in your portfolio when you can go short or sidestep that market and buy back cheaper using options and selling puts to collect some premium, or just finding buy points that are lower for you. But interesting seeing his thought process. I agree with you, Big Eb. It is interesting. That's why I love teaching and working with OTA, right? I get to see a lot of these instructors and the way that they think, learning from Larry and Todd Davis and Scott McCormick has just been a blessing over the years for me. So hopefully you guys enjoyed that one. Let me real quickly go into just the economic, because I noticed we're at an hour and we have a big wins issue here, and I got to take down some decorations, which I think are actually blowing away as we speak. So let me go over to this screen. I will show you the economic calendar for today. As you roll through this, I know the big stuff is for tomorrow. We'll get there in just a second, but there was really positive news on a lot of fronts. Final manufacturing PMI was at 50.4. That was way better than expected. You also had a positive number for both those manufacturing numbers, over 50, which means slowly showing some optimism. JOLTS job openings were way higher by 1 million more jobs than expected open. Construction spending was better. The only one here that was not good was the ISM manufacturing prices. So all in all, things looking very good from the U.S. equity perspective. Now, what else did I have on this one? That was economic. Let's go earnings. Most beat. AMD is actually the only one I've seen this earnings season that came out exactly, not locked dead on what their earnings number was supposed to be at 67 cents. But you can see BP beat. Everybody that reported on this chart here beat. That's Eli Lilly, Chesapeake Energy, Enterprise Product Partners, Pfizer, etc. So a lot of really positive stuff out there for today's market. I wanted to add 2 things in here. Number one was I am going to try to do this on a regular basis just to get everyone in tune with it. But that is, where is it? There we go. I updated this with the 2 people that decided to add to it. So Tom, Gary, Lisa, and myself, I've added you to the November challenge. If there is anybody who's watching the podcast wants to add yourself to it, just email me at tradermerlin@gmail.com or put it down below the YouTube video and I will add you to the November challenge. 100 push-ups a day is pretty damn tough. So Gary, I'm pulling for you. It's a challenging one to do. You got 24 hours to do 100 push-ups in any way that you can. So Lisa's doing yoga 5 days a week plus. Mastering the plank. I put planned. It should be PLANK on this one. And then Tom with his bodyweight reps and trading, no violation of trading plan, and Gary with 100 push-ups. So there we go. Now let me go into other pieces here and wrap up today's show. When you look at tomorrow's activity, we have some earnings which are going to be important. You have Qualcomm, CVS, Bookings Holdings, which used to be Booking.com, Estee Lauder Companies, Humana. There's also a bunch more than this, but those Roku I think is also reporting earnings tomorrow. But I just put some of the bigger names on this chart here. Now, from an economic announcement perspective, the big stuff, as you know, really visuals are blurred at times on my screen. That really shouldn't happen. I notice I'm not having any drop frames per second, so I should be good. Really, the big news is going to happen at 11 a.m. Pacific time tomorrow. That's the FOMC statement. You can see priced in 75 basis points. What will be even more exciting will be what happens at 11:30. That's when Jerome Powell speaks, and who knows what on earth is going to happen with that announcement. He's going to be under a lot of pressure about inflation, about the GDP numbers. I guarantee you he will be citing the most recent GDP numbers, saying, look, we're seeing an increase in GDP that's showing some signs of relief, and that may calm people a little bit with regards to 75 basis point increase at the next meeting and maybe even drop it to 50. But what I can assure you is between 11, let's just say 10:55, you should probably take your hands off your keyboard because whipsaws are going to happen wildly right around 11 o'clock. And you don't really even know what has been said, but all of a sudden it rips up and then comes screaming back down, and it just creates a big headache. And then the statements that are made around 11:30 can also create a lot of waves. Other economic announcements happening tomorrow. Well, you can see a lot of manufacturing numbers coming out for Europe, Germany, France, Italy, Spain, all coming out with their manufacturing numbers. We do have ADP non-farm employment change and crude oil inventories as well for the U.S. And then later on, you do have nothing really that important here for New Zealand and Australia. All right, well, that's going to do it for me, everybody. I hope you enjoyed that one. Again, I have actually more to go to, and I want to get to some listener questions, but I'm at an hour, and I got to get some other stuff done here. So tomorrow, I will dive into the listener questions that were posted on the YouTube channel. You can just put whatever comments or questions you have on the YouTube videos, any one of them, and I will find, 2 p.m. Eastern Standard Time at 11 a.m. Pacific Daylight Time. I love the fact I've been using PST for the last 14 years doing these shows, 13 years, and Arvin caught me, and he's like, it's PDT right now until November next week. All right, I change it, PDT. Yes, get your neck brace on, Chris. It is going to be a wild one. So that'll do it for me. Comments, questions, put them down in the YouTube video or email me at TraderMerlin@gmail.com. No guest tomorrow, but we will have Ryan Watkins on Thursday. And then, seeing as how I received a bunch of wonderful whiskeys for my birthday, I will probably have some nice whiskey on the Friday show. So that said, everybody, hope you have a fantastic trading day tomorrow. I will see you on Wednesday. Take care.